everyone is calling it a bubble. The same people who missed the entire run-up are now confidently telling you it is over. Nvidia is worth more than every company on the Toronto Stock Exchange. Combined. Every single one. That is not a typo. And here is what nobody in Canadian personal finance is saying out loud. The people most likely to make the wrong decision when this gets ugly are not reckless speculators. They are disciplined, hardworking, established immigrants who learned to read financial danger correctly in a country where financial danger looked completely different. Your instincts are not broken. They are just calibrated for the wrong system. That is what we are fixing today. Let me tell you what the actual risk is for this audience. It is not that you will buy Nvidia at the top. Most of you will not even try. The real risk is what you will do to your TFSA when the market gets loud and scary. Statistics Canada data shows that fewer than half of eligible Canadians have ever made a TFSA contribution. Among immigrant communities, that participation rate is even lower, which means a significant portion of my audience is sitting on years of unused contribution room right now. Room that is gone permanently every January 1st if you do not use it. The AI bubble conversation is going to drive fear into the market over the next 12 to 24 months. Volatility will spike. Headlines will call tops. Your colleagues will tell you they sold everything. And if your financial instinct was built in a country where that kind of noise reliably preceded a crash, a currency devaluation, or a bank closure, you are going to feel a very specific kind of pull. The pull to get out. To hold cash. To wait it out until things are clear. That instinct will cost you. Not because it is wrong in general. Because in Canada, acting on it inside your registered accounts has consequences the Canadian system does not forgive. Let me put 3 numbers in front of you. The first one is from Bloomberg market data. At its peak in 2024, Nvidia's market capitalization reached approximately $3.3 trillion. To put that in Canadian terms, that single company was worth more than every business listed on the TSX Composite Index combined. Every bank, every energy company, every retailer in Canada, added together, and one American chip company was worth more. Now, is that a bubble? Maybe. But here is the more important question for you specifically. The question is not whether AI is overvalued right now. The question is whether you have positioned your Canadian registered accounts to survive both outcomes. Whether the bubble inflates further, or whether it corrects sharply. The second number comes from the CFA Institute's behavioral finance research. Loss aversion, the tendency to feel the pain of a loss approximately twice as intensely as the pleasure of an equivalent gain, is consistently stronger in people who have lived through economic instability. Currency crises, hyperinflation, banking collapses. If you grew up in Nigeria in the 80s, in the Philippines during the Asian financial crisis, in Venezuela or Zimbabwe at any point in the last 20 years, your loss aversion is not just a personality trait. It is a learned survival mechanism. And the third number is the one that connects to your wallet directly. The TFSA annual contribution limit in 2024 is $7,000. If you have been a Canadian resident since 2009 and have never contributed, your total accumulated room is over $95,000. That is $95,000 of investment growth that could be completely sheltered from Canadian tax. Forever. The AI bubble story is happening right now. Your response to it will either grow that $95,000 opportunity or it will cost you a decade of compounding. I want to be honest with you about where I was on this. When ChatGPT launched in late 2022, I knew it was significant. I have spent 2 decades watching technology move through industries. Oil and gas. Aerospace. I have seen what happens when a genuinely disruptive tool enters a sector. You feel it before you can prove it. But I kept it down low, as we say. I did not move aggressively. I told myself I needed more information. I watched the valuations climb. I tracked the commentary. And I waited. Now I understand something I did not understand clearly enough back then. I was not being cautious. I was being shaped by a version of caution that was built for different risks. The instinct to wait for certainty before committing money was not a neutral, rational instinct. It was the instinct of someone who learned that moving first, before the full picture is clear, is how you lose everything. That lesson came from watching economies fail. It was the right lesson in those economies. Here is what I have since concluded, and this is not a prediction, it is an assessment. The AI bubble conversation is framing this entirely as a hardware story. Nvidia chips, data centers, infrastructure. And yes, there is concentration risk there. But the integration layer, the question of how AI moves into logistics, healthcare, human systems, the body itself, that is still in the first chapter. We are not at the dot-com crash equivalent. We may get there. But we are not pricing in what full integration looks like yet. So what did I do? I diversified. Not because I was uncertain in a paralyzed way. Because the Canadian financial system rewards diversified exposure inside registered accounts more than it rewards concentrated bets. I did not go all in on AI, period. I did not exit equities. I used the tools Canada gave me to stay in, spread across, and stay tax sheltered. That is not timidity. That is the Canadian system working exactly as designed. Here is the framework. 3 moves. Each one is specific to the Canadian financial system. Each one is implementable before the end of this month. The first move is what I call the anchor review. Before you make any investment decision in response to what you are reading about AI right now, open your TFSA and your RRSP statements. Not your brokerage app. The actual registered account statements. Look at 2 things only. 1. How much unused contribution room do you have? 2. What percentage of your holdings are in a single sector or a single asset? If you have unused TFSA room and your money is sitting in a savings account inside that TFSA earning 0.5%, you are not being safe. You are being penalized. The TFSA is a container, not a product. The safety is not in the account. The safety is in the tax shelter. What is inside the container is your decision, and right now, a high-interest savings account inside a TFSA is losing to inflation every month. The anchor review takes 30 minutes. You need your CRA My Account login and your most recent account statements. Do it this week. The second move is the diversification floor. The AI bubble debate is specifically about concentration risk. One sector, a small number of companies, presenting a disproportionate share of global market value. The Canadian response to that risk is not to avoid equities. It is to hold a diversified base position that does not depend on any single narrative being correct. In practical terms, for a Canadian investor using registered accounts, this means holding a core position in a broad market index ETF, either a Canadian index, a global index, or a one-ticket solution like a balanced ETF, before making any satellite bets on specific sectors, including AI, period. The diversification floor means you are never fully wrong. If AI corrects 30%, your floor position absorbs the volatility. If AI continues to run, your floor participates through the global index weight. Here is what this looks like in a sentence you can use with your financial institution. I want to hold a core position in a low-cost broad market ETF inside my TFSA, and I want to discuss adding a smaller satellite position in a sector I believe in, such as technology or AI infrastructure, with the understanding that the satellite is capped at a fixed percentage of my total portfolio. That sentence signals to any advisor that you understand the structure. It also protects you from being sold a concentrated product without the floor underneath it. The third move is the volatility anchor date. This is the most important one for this specific audience. Choose a date. Pick a date 12 months from today. Write it down. The date can be anything: your birthday, the end of a fiscal year, a date that means something to you. On that date, and only on that date, you are permitted to make a structural change to your registered investment accounts in response to market conditions. Between now and that date, you can add contributions. You can rebalance to your floor. You cannot exit a position because of a headline. You cannot go to cash because someone on YouTube told you the bubble is about to pop. The volatility anchor date is not a rule imposed by the Canadian financial system. It is a rule you impose on yourself because the Canadian financial system rewards patience and penalizes reactive behavior inside registered accounts. When you sell inside a TFSA and move to cash, you do not lose the contribution room, but you do lose the compounding that the system was designed to protect. Every year you spend in cash inside a registered account is a year of tax-sheltered growth that compound interest cannot recover. 12 months from today, with your anchor date in front of you, you will make a calmer, more informed decision than you would make next week when the next AI headline drops. That is not a personality change. That is a structural decision. And the Canadian financial system will reward it. The AI story is not finished. Anyone telling you it has a position they are trying to protect. What is finished is the excuse that you did not know how to respond inside the Canadian financial system. You now have 3 moves: the anchor review, the diversification floor, and the volatility anchor date. Run all 3 before the next headline tells you to panic. If this gave you something you have not heard from anyone else in Canadian personal finance, subscribe. The next video covers the Canadian account structure that most multicultural newcomers are underusing right now, specifically the FHSA. The account Canada built in 2023 that functions like a TFSA and an RRSP at the same time, and almost nobody in this audience has opened yet. The bubble may burst. The system will remain. Build inside the system,